Good morning. This is Anthony Parent of IRSMedic, and today is the last day Joe Biden's presidency, and we're going to celebrate that. John's celebrating with his coffee from Toronto McDonald's. There it is. Right on, John. Thanks so much for joining us today. Unfortunately, Keith is a little bit under the weather, so he won't be here today for today's topic, which is unfortunate because this really affects a lot of people, or could affect a lot of people in France, right, John? I mean, that's really, as I'm reading this, like, hey, that's really a place where there might be some people, to get to the point that I'm trying to get to, there might be some people who the U.S. Treasury owes money to. And France would be a place that potentially, because of this decision, is that right, John?
I think it affects Americans abroad generally. That would include France. I mean, we've got basically two important decisions here. The Bruyea one out of Canada, the Christensen one out of France. So, I mean, it's a big deal. This is a big deal for all Americans abroad.
And I think, really what we're looking at here is treaty interpretation in recent decisions. These aren't old decisions. These are, hey, this is how treaties are getting interpreted now. And I think some very helpful things that we're going to dive deep into. So really what we have is treaty interpretation that is actually helpful to Americans abroad. Yeah, I mean that. Yeah, really incredible stuff. So, John, you got a presentation, and I got your blog up. So where do you want me to start today?
I think probably we should start with a discussion of the general issue before we get into the,
that's even better.
All
right.
Yeah. So I don't know. You want me to start, or do you want to start, or what do you want to do?
So, John, here's where I want to start, John, is that as I look at these, where, we have treaty interpretations and we have a court laying out how to interpret things. And this is really the point that I found fascinating, is how utterly picky and obstinate in a way the U.S. government was over this. They're just like, yeah, no, we're going to claim these words mean something else. And it really didn't seem to me. It didn't seem like to me, John, that the government had a great argument. And it seemed like they were being very pedantic and maybe not even pedantic, just incorrect and digging their feet in. They just didn't want it. And like they're holding on to this thing like it's so precious, right? That's what I was seeing. That's my general impressions of that. And that's kind of what I want to start with, to see how this develops as we go.
Well, Anthony, you're behaving like a lawyer this morning. That's how a lawyer would see it. So thanks for confirming you're a lawyer. Why don't we pretend? Why don't we start off pretending we're not lawyers for a minute?
Oh, okay.
Okay. People will like you better, Anthony. Probably. But I think we ought to explain the general context of the issue here and why this is important for Americans abroad before we get into the treaty itself. So I can take a stab at that, or you can take a. So why don't you say, John, why does this matter for Americans abroad?
Why is this case a big deal for Americans abroad, John?
Funny you should ask that. Well, so basically, we start off with the principle that Americans abroad are subject to the Internal Revenue Code, right? And in 2010, the then President Obama created this new big thing called Obamacare, and it was some kind of a national health insurance thing. I have no idea what it is, because I don't live there, but that's what I'm led to believe. And in order to finance this, they created something called the net investment income tax, which, in a general sense, is a 3.8% tax on investment income. Think interest, dividends, capital gains. And by the way, whether foreign or domestic, right? Okay, you could have foreign investment income, domestic investment income, and so this is a brand new tax. Running, I think, sort of alongside the rest of the stuff in the Internal Revenue Code. And you know what? To get to the bottom line, the way the U.S. has been, so the first thing is that if you look at the way that this new tax is presented, the taxes that we talk about all the time, Anthony, are in Chapter 1, Subtitle 1. But this is not only is it a new tax, but it even gets its own chapter in the Internal Revenue Code, Chapter 2A. Now how cool is that, right?
Wow, you really matter.
Chapter.
Yeah.
And as Nancy Pelosi famously said before this was enacted into law, well, we really must pass the law so that we can see what's in it, right? You remember that?
I remember that. I remember that. Yes.
So I'll tell you what's in it. What's in it is the way it's written. That basically, you know what? If you have the temerity, if you are so dishonest, so disloyal, so unpatriotic, as to have any investment income that is foreign source income, you know what? You know what we're going to punish you? We're going to punish you by disallowing the use of taxes paid on that foreign income in that foreign country. We are going to disallow that as a potential tax credit. So you know what, buddy? If you invest in foreign income, we will punish you by disallowing a tax credit on that. So what do you think about that, Anthony?
Well, yeah. I mean, this is one of the things where you're just saying, the government really doesn't seem to have a bottom to its depravity. This is. I mean, actually, this is actually a light one. They're just double taxing you in a way, and they're just denying something.
Anthony, my God, you hit the nail right on the head. You see what happens
when
you take off your lawyer hat? You got it. Okay. What it is, okay, it's pure legislated double taxation. Are you listening, Solomon? Are you listening? It's
pure double taxation.
Double taxation.
And it's like we have that thing, though. Yeah, John, but we have that thing, right? We have that thing called treaties to prevent double taxation. So
now you're starting to behave like a lawyer again.
Oh, sorry, John. I'll go back. Let me walk that back. All right, let me walk that back.
Well, that's exactly right. So what happens is that then everybody jumps and says, well, we've got the treaty to prevent double taxation, and what do you think the IRS position on that would be? Can you use a treaty to prevent double taxation when the Internal Revenue Code imposes double taxation? Can you do that, Anthony?
Right. The tax code is the highest law of the land. So it would seem IRS would beat any treaty, whatever that's going to be. That's just foreign relations with another country. But we got the tax code to implement here.
They found that the notion that somehow a treaty could be used to prevent double taxation on the net investment income tax. Think of it, Americans abroad are more likely to have foreign investment paying this tax for a service that they're specifically precluded from even using. That's what makes it even better, right?
Oh, right, yes. Obamacare, you can't use Obamacare overseas. So, yes, you must pay the tax for Obamacare, which will result in double taxation for a service that you can't use. Okay, so now we're really the government.
Do you think this is what President Trump means when he talks about creating an external revenue service instead of the internal revenue service?
Oh, wow, right, yeah. Squeezing everybody overseas here. All right, so I think we got the issue. So, I mean, this is pretty crazy.
So, this is the issue, right? The issue is, whether, and if so, to what extent, U.S. tax treaties can be used to prevent an opportunity for this slimy, filthy American abroad who's a tax resident of another country to somehow be able to use the treaty to use foreign taxes paid on investment income as a credit against the majestic and just U.S. net investment income tax when the Internal Revenue Code doesn't allow it. Doesn't this sound to you, Anthony, like just totally unreasonable and unjust to let these Americans abroad get away with this and use a treaty?
And that's exactly my point, John. When I'm reading this, I'm just like, they are just out to get you. I mean, they're taking the most adversarial position possible. And you're thinking, why? And it's because the U.S. government is your greatest enemy if you're a U.S. person. And likewise, the U.S. government is the greatest person if you're not. They're really out to get you. But here we go. I mean, but I want to get into the decision because we have some good news here. Right, John? We have some good news.
Well, we have, after a long, long journey in a dark tunnel with ice slipping around, etc., we have basically a ray of light, okay, at the end.
Here it is.
There might be some hope. It's one decision, but I think now is the time to start the presentation.
All right. Perfect. Perfect. All right. Let's add this one to the stage here. Here we go.
Here we
Beautiful.
go. Look at this. U.S. tax treaties and the NIIT. Does the tax treaty apply? All right. Well, that's what we're talking. And look at this. We're doing this on January 20th, 2025, the day of the beginning of the External Revenue Service, right? Cool. All right. Well, let's see what we got.
Let's get it. Here we go. Right.
Part A, looking solely at the law of the USA. I pulled that offline. Look at that. Don't you think that the Internal Revenue Law is even bigger than all those volumes? I mean, Anthony?
Yeah, that's not. Yeah, God, it's much bigger than that. I mean, that's probably not the annotated.
But I think that what people need to understand is that somewhere in that collection of books are provisions that specifically say to Americans abroad and domestic Americans as well, right? Okay. That if you have the temerity to invest in a foreign asset that gives you foreign investment income, it's your problem if you have to pay tax to that foreign country. We are not going to allow you to use that tax as a tax credit. So that's what it looks like from the perspective of the law of the land. But is it possible that a treaty might make a difference? That's what we're going to talk about today. Okay, next slide. All right, now, Anthony, I'm going to behave like a lawyer for a minute, okay? But don't tell me not to, okay? I got to do this for a minute, okay? All right? And you'll like this because I know deep down you're a lawyer, okay? So you'll like it. That's right. But a minute ago, we saw that whole collection of books, and so that's the Internal Revenue Code. That's Title 26, and that's divided into subtitles. And subtitle A, I think, is going to be the income taxes. Okay, and that's sort of where the action is. And then, of course, we're going to divide subtitle A into all these different chapters. Now look at this cool stuff, right? So we have chapter 1, which is the normal taxes. This just means the stuff that you interact with every day, regular taxes. But I want you to also notice that we have the newly created chapter 2A. How cool is that?
There it is, all by itself there.
And that is only one section in it, really, okay? Or one. It's only for one purpose, and that is to create the net investment income tax to finance Obamacare. And I don't know. Do you think this is what Nancy had in mind when she said we really must pass the law to see what's in it? That's part of what's in it right there, chapter 2.
I think that's what she wanted to see, right here we are. So she wanted its own chapter. There it is. Yeah, we need it. It's so special.
So you have to understand this structurally and understand how this works. All right, next slide. Wow. Now you talk about these foreign tax credit things, and you know me, Anthony. I think when we get started talking about legalistic stuff, I always feel we should figure out where it says it. And if we look in chapter 1, section 27, this is really the section of the Internal Revenue Code that provides the foreign tax credit rules, right? Or at least provides the predicate for it. It's not 901 at all. Okay, it's section 27. So what it says is this, right? Taxes of foreign countries and possessions of the United States. All right. Aren't foreign countries the possessions of the United States? Why should one? I mean, come on! We're now in the Trump era.
Oh God!
Isn't Greenland? Isn't Canada? Aren't these?
It's all U.S. It's all U.S. Why?
Well, anyway,
being redundant. Yeah.
So here's what it says. Now, here's your general principle. The amount of tax imposed by foreign countries and possessions of the United States shall be allowed. Now we need to be real careful here, right? Yeah, as a credit against the tax imposed by, whoa, look at the next two words, this chapter.
Right.
Chapter 1.
Not chapter 2A.
That's
chapter
right,
1.
Not chapter 2A. Oh my God. So in other words, see, this is how they did this, right? This is how they managed to create internally a law that says that, You can invest outside the United States all you want, as long as you report it as a PFIC or a CFC or a this or a that, right? You can do that all you want, and you can get all the income you want. Now I'm going to take a Joe Bidenism, but you got to pay your fair share, okay? You got to pay your fair share, okay? And what they're saying is this, that in order to help you pay your fair share, you know what? We're not going to allow you to pay part of your fair share with those foreign taxes that you paid to that other country, right? Well, now this is interesting, isn't it? And by the way, this was not when this law, when this law was passed, this is not what people were seeing initially at all. I mean, I remember tax preparers just simply assuming, that people would get a foreign tax credit for this net investment. They couldn't even understand why this was an issue. Now you see why it's an issue.
Yeah. I recall when we had the aha here. We're like, what? No. Oh, come on. And just an awful, awful feeling for so many people. I mean, just.
All right.
All right. So yeah.
So let's continue on here and see where and we need to go to the next slide to see what's in it. Okay.
All right. Let's go to the next slide to see what's in it. All right. Oh, wait.
What about the tax treaty?
Yeah.
God damn it. Doesn't the tax treaty provide some relief on this? Can a tax treaty create a credit for foreign tax that extends beyond the provisions of the Internal Revenue Code? Oh my God, you could imagine if somebody from Treasury heard that question, it would short circuit their brain.
I got it. Right. I know. They're up at night. They're having a hard time sleeping. This is the stuff that, yeah.
Is there anything powerful enough in the world to create something that is in addition to the internal? Is there anything in the world worth considering but the Internal Revenue Code?
I really do think about the poor Treasury employee right now, thinking about, oh my goodness, that a treaty may overrule us. I mean, are we relevant anymore? A total lack of identity, falling into crisis. I mean, these poor Treasury employees.
Yeah, I think this would be horrible, right?
Yeah.
Well, what we've got here to answer is we have Judge Blank in the Christensen case coming out of France, and Judge Solomson in the Bruyea case, if I'm pronouncing it correctly, coming out of Canada saying, yes, by God, tax treaties matter. Think of it, Anthony.
Amazing.
But
that treaties who are ratified through the constitutional process would actually matter.
It's unbelievable, isn't it? Right, yeah. But, they reach this conclusion for very, very different reasons, okay? And this is part of the problem. So although this is good news, we are not out of the tunnel yet because these are going to be appealed. But let's see what Judge Blank and Judge Solomson say on these issues.
That's what we're here for. All right, here we go.
All right, now, this is real complicated, okay? I'm going to dumb this down as much as I can because I'm much more comfortable with, anything dumb. I'm going to try. So here, now I'm going to use the U.S. model tax treaty to explain this and not either the French or the Canadian one. But generally speaking, the discussion today will carry over. So we have Article 23. Now, notice, by the way, and we've talked about this before, it says relief from double taxation. Notice it does not say preventing double taxation, right? So for all the people who claim there's no double taxation, well, that kind of says there is relief from double taxation. Yeah, okay. All right. So now, again, I'm using the model treaty here, the model treaty, and this would carry over to other treaties, okay? It says in the case, and now I'm going to fill in the blanks to keep it even easier. In the case of the United States, double taxation shall be relieved as follows. Now, here we go. In accordance with the provisions and subject to the limitations of the law of the United States, as it may be amended from time without changing the general principle, the United States shall allow a resident or a citizen as a credit against the United for an income on income applicable to residents and citizens. All right. All right. Now, then they fill it in. The income tax paid or accrued to, let's say that person lives in Canada, to Canada, right? On behalf of a U.S. citizen. So what this seems to be saying, right, is that, so we know that Americans abroad are subject to double taxation, or not just Americans abroad. We know that there are U.S. citizens or residents who are subject to double taxation. Some of them live outside the United States. That may or may not matter. Does it matter? You bet it matters. Okay, because remember that to get the benefits sometimes, okay, you need to be a tax resident of the other country, but I digress a little bit, okay? But what I want you to see here is that, notice this does not say, in the case of the United States, double taxation will be relieved by providing a credit for taxes paid in the other country. No, no, no. What it says is that it will be relieved in accordance with the provisions and subject to the limitations of the law of the United States as it may be amended. What the hell does subject? Does that mean that although the treaty requires the United States to provide relief from double taxation, it doesn't really have to provide relief if U.S. law says there's no tax credit? Is that what it means? What do you think, Anthony?
So the thing that I get hung up on that just sort of stands out to me here is when I see this statement says, subject to the limitations of the law of the United States. Okay, well, all right. Well, what do you mean by law? And oftentimes, as we joke, but not really joke, that we have proven time and time again, the true Constitution of the United States of America is a tax code, and then anything on a website or instructions or anything that can kind of be thrown as a tax. And the Constitution tends to take a back seat. And that, you know, and so it's like, well, when you say the law of the United States of America, because here's the thing, you have a tax treaty that's ratified by Senate. It goes through the process to be a ratified tax treaty. Tax treaties are what defines your foreign relations with other nations. And you're saying, well, you're saying that can a tax treaty be negated by an act of Congress? And I would say no, because it's not the policy. It was not ratified by the Senate. And that's the problem you would have structurally with this, is that you're having a statute directly undermine, or I wouldn't say direct, I guess it is more indirectly undermine a tax treaty. That's what I would say. That's kind of what stands out at me. That's my little lawyer hat on there, though.
Well, yeah, I mean, who knows, right? If we knew, we wouldn't have all this litigation. But I think what is clear as a starting point is that what this does not say is that the United States will provide a tax credit for foreign taxes paid. There's some gobbledygook in there that conditions it on something or other, right? Correct. And that something or other appears to be subject to the limitations of the law of the United States, whatever that's supposed to mean, right? Now, let's just pause with that thought for a second. Now, a minute ago, when we put on our lawyers' hats for a minute, we looked at the structure of the Internal Revenue Code, and we kind of concluded that, well, because the net investment income tax is in Chapter 2A and the tax credit rules are in Chapter 1, that, well, under the Domestic Internal Revenue Code, you're not going to be able to get a tax credit for this. So does this mean that that section of the tax treaty cannot be used? You could not apply that to be able to get a credit for tax paid on non-U.S. source investment income? For example, let me make up an example. Let's say Canada, because I'm feeling lazy and it's because where I'm sitting. Let's say that you have $10,000 of investment income from having bought, I don't know, some Canadian stocks or something, right?
Yeah.
And you know what? Canada actually has a fairly brutal tax regime. Okay, now they're going to.
Yeah, I heard. Oh,
it's going to be reported. Okay, I mean, the way I experienced living in Canada, I just presume everything I make is taxed away, and I get to keep a little bit amount.
A little bit of an allowance, right? I mean, that's it. There you go. Right.
All right, but so the question then becomes, right? So you pay, I don't know, let's say probably 90% tax on that in Canada. are you able to use that as a tax credit against the U.S. tax? Because remember, the U.S. will tax you, right, if you're a U.S. citizen or resident. Well, remember, it's going to be included under Chapter 1 as basic income. So, yeah, you're going to be able to tax credit for that. But the extra tax, the Obamacare surtax, the question is, can you use the tax paid in Canada on that Canadian investment income to offset as a credit against the net investment income tax imposed? What do you think, Anthony? Looking at that.
Yeah, and I would say that I know the Treasury would say absolutely not.
That's exactly what they say. And
yeah.
they say it precisely because of the language subject to the limitations of the laws of the United States. Right? That's what they say. Now, there are people who find this offensive. And you know what some of those people have done? By God, they've taken the IRS Treasury to court and saying, no,
God
buddy,
bless them.
no. But they've done this for different reasons.
Yeah.
Okay, now what we're looking at here is only one paragraph, right, of these double taxation treaties. And I would say that paragraph, in substance, is in all of these treaties. But then they start to vary from country to country, right, in terms of other options. Now, in the Christensen case, the French tax treaty, you ought to see the double taxation clause. Oh, my God, it's incredibly complicated, or at least I find it so. And in the Christensen case, what Judge Blank did was, now I'm going to say two things here. Said on the issue we're talking about, this paragraph 2 or whatever it is, right? Say, no, Judge Blank agreed with the government and said, nope, because the net investment income tax is in Chapter 2A, foreign tax credit rules are in Chapter 1, the law of the United States is such that you do not get a tax credit, okay, for foreign taxes paid on foreign source income. So, no, you lose on that, but pursuant to another provision of the treaty, Judge Blank ruled that there was an independent foreign tax credit created. We can do another podcast on another one if you like, but that's a somewhat more complicated issue. But the point that I want to make here is that Judge Blank says, if you're looking only at that provision of the treaty, says, sorry, out of luck, buddy, you lose. Okay, we cannot take that provision of the tax treaty and allow you to get a foreign tax credit based on it because the domestic U.S. Internal Revenue Code specifically does not allow it. So far, so good?
Yep, got it. Understood.
Now, Anthony, I got to tell you that Judge Blank was not alone in this. Okay, there have been a few other cases on this whose names escape me. But, I've written a series of blog posts on this. If anybody's interested, you can put them up or whatever. But the point is that the prevailing view on this has been that particular section of the tax treaty absolutely precludes somebody from getting a foreign tax credit to offset that intentional double taxation if they have non-U.S. source investment income on which they paid non-U.S. source tax, right? Now, this is interesting and, not exactly very good news. Now, this has been going on for a long time. And parenthetically, there have been other arguments about this. Okay, some people have argued, I think very rationally that, precisely because this is in Chapter 2A, that it's actually a Social Security tax, and therefore, if you're in a country with a totalization agreement, you shouldn't have to pay it.
Oh, yeah.
Yeah, that's a separate argument, but
Yeah.
that never went anywhere either. Okay, so basically, what happened was that until the Christensen case, which relied on a completely independent section of the tax treaty, not this one, but another one, there had been no relief for Americans abroad on the issue of double taxation for the NIIT, right? That's where we've been. Well, okay. Until Mr. Bruyea, if I'm pronouncing his name properly, comes along. And, one point I want to make here, the net investment income tax at issue, I think was around $250,000 or something. And that tells you something about the magnitude of the gain here.
Wow, yeah.
But anyway, somebody obviously made a lot of money. But in any case, the reason I mention that is because you need people to make a lot of money, because these are the only people who can afford to challenge this stuff. Okay. So, in terms of tax reform, you want people who make a lot of money being unjustly taxed. That's what you want. Okay. I mean, obviously, I think it's fairly obvious that the only purpose of denying the tax credit for foreign source investment income is to punish people who invest in foreign source stuff,
Yeah.
right?
Yeah.
That's the only reason for it, clearly. All right.
Right.
I don't know why people have such trouble saying that, but that's obviously the case, right? It's just one more provision in the Internal Revenue Code that punishes people by denying foreign tax credits in certain circumstances, right? Okay. So Bruyea comes along. Okay, let's see what the next slide says here. Okay, now what I'm doing is I've got the actual Canadian equivalent of this up here. So in the case of the United States, subject to provisions of paragraphs 4, 5, and 6. Now, the provisions of 4, 5, and 6, by the way, are provisions that apply specifically to U.S. citizens resident in Canada. Okay, and this is one of these more modern tax treaties. Double taxation shall be avoided as follows. In accordance, now here we go. In accordance with the provisions and subject to the limitations of the law of the United States. All right. In other words, in terms of what's relevant, is the exact same language. Agreed?
Yep.
So here we go. Next. Now, so here's what Judge Solomson in the Bruyea case has in front of him. It's like two ships passing in the night. Obviously, Bruyea thinks that section should be interpreted to allow a foreign tax credit. The government says no. So the issue becomes, what is the meaning of subject to the limitations of the law of the United? What the hell is that supposed to mean? Can that really mean that the U.S. has no obligation to provide a foreign tax credit? Is that what it really means? That's what Treasury's arguing, right? Okay.
Yeah. It seems like we have a conflict of laws, and Treasury's going to say the one that was particularly, and that's the thing, it was particularly put in a separate one, and also looks like intentionally, so the credits wouldn't apply.
Yeah. Now, I think it's worth interjecting with one very, very important point here when we talk about interpreting the treaty. And this is a fascinating case. As is Christensen, they're both fascinating cases on treaty interpretation. And I think we should do, a couple more podcasts on those aspects of it. But I think it's important to understand that tax treaties will always say, what is the body of law that this is designed to govern, right? And the Canada-U.S. tax treaty, who could have known? It says tax laws under the Internal Revenue Code, and in Canada, the Income Tax Act of Canada, right? Anthony, would you say that Chapter 2A is part of the Internal Revenue Code? Do you think?
Yeah.
Yes, isn't it?
I'm going to say it is, yeah.
Yeah, and you don't even need to be a lawyer to figure that one out. All you have to do is look at the picture we had up earlier, right?
Yeah.
Yeah. So it seems fairly clear to anybody but a Treasury lawyer, okay, that, obviously the net investment income tax is a tax that's contemplated by the tax treaty. Agreed?
Yep.
Okay. Maybe you make a separate argument, does this somehow override the treaty? That, that was discussed. Let's not talk about that today. Let's just talk about how to interpret this, okay? But, it's pretty clear, okay, that this is a tax under the Internal Revenue Code, therefore the treaty should govern it, right? So the question is, all right, does this provision, this sort of sleight of hand, kind of like a saving clause, right? But no, the United States doesn't really have to provide a foreign tax credit, even though it says it shall. This sort of Alice in Wonderland interpretation, right? Should that prevail, Or should the judge say, look, come on, these arguments I'm hearing from you Treasury lawyers, it's just way above my pay grade. I'm sorry, I don't understand what you're talking about. We got a treaty here that specifically says the United States has to give foreign tax credits. What is there to not understand here? In other words, what you're arguing for is completely nonsensical. It would negate the whole purpose of the treaty. So there's no way that the phrase subject to the limitations of the law of the United States can possibly mean an outright denial of the foreign tax credit. Right? Now that's what the non-lawyer would say. Okay?
Right.
So anybody can understand this, right?
Yeah.
So now, next slide. So the issue, Jesus, I think I sound more like a lawyer here. Sorry about that. So Judge Solomson, in contrast to the Judge Blank and Krishna, okay, what he says that, this is really important. He says, sorry, Treasury, but you lose. Because what you're really saying is that a tax treaty cannot create a tax credit that's independent of the Internal Revenue Code. And that's obviously wrong. Tax treaties can create a foreign tax credit that's independent of and extends beyond what the Internal Revenue Code allows. And the issue of whether a credit is allowed is determined, now here we go, under the tax treaty. Holy shit. Can you imagine the tax treaty, being a higher law than the Internal Revenue Code?
Oh my goodness.
I mean, this would send, these people at Treasury.
There it is. Yeah.
I mean, the rest of their lives.
And I think this gets so this is again, in Bruyea, hopefully I'm pronouncing it. If anyone's from that case and you want to chime in, let us know. Really, the crush of it, hey, look, we're going to say the tax treaty is a higher law than a statute, basically, right? I mean.
Well, it would include that. All right, so let's see where we go. Now, that's what he said, okay? Now, now think of how shocking this is.
Right.
Now,
right, and this is the thing that Treasury workers, they're waking up at night in a panic to say, oh my God, we might lose this and we don't want that. And then what will happen next? And we're having some Treasury workers commenting now too. So, okay.
In fact, I mean, this is so significant. It's probably created a new type of therapist in DC called the tax treaty therapist.
When you're worried about everything you hold dear is going to fall apart.
Exactly.
Some people, you can't double tax people.
The idea that treaties might give rights, is it keeping you up at night? Come to me, the tax treaty therapist. All right, let's go to the next slide. Oh, that's it.
There it is. Here's the next slide.
Now, notice that I end with the arc of the moral universe is long, but it bends towards justice. And I think that's appropriate because isn't today Martin Luther King Day?
It is. It's a bunch of things today, right? We have a little news going on, and I think we're getting some interesting comments today. We have some news going on. President Trump is getting inaugurated, and I just say, John, this. Look, someone paid $1.99 for this comment, John. So I'll just put it up here. All right, I don't want to deny someone their $1.99 their value. So I didn't know you could do this, but so I mean, here's a not a banned account saying how can we resist Trump and save our IRS workers? This is great. This is great, and I'm like I don't even know what to say to this comment. Like, wait a second. All right, so just understand, because if you are that person who can't sleep at night, because you're afraid that the IRS isn't double taxing somebody overseas, or somebody isn't taxing retroactive income, one of your heroes really should be Donald Trump, because he passed in the law, the Tax Cuts and Jobs Act of 2017, which imposed a transition tax, which is a retroactive tax on income never received.
Absolutely.
So it's like that's what they should be celebrating. So I think what we have is people not understanding that, look, they're kind of in it together here, folks. I don't know what to say. Hopefully Trump means what he says on ending double taxation. We got him to get that promise through. Hopefully he means it. But look, they come together on these things. And, yes, and you're right that, hey, look, Treasury workers have been abused horribly. I mean, Treasury workers, I'm actually on your side because I know a lot of you, your lives are miserable. You do something that you can't say, no matter where you are, whether you're an exam, collections, or even a taxpayer advocate. you guys are pretty good. And there's so many of you who I like. And I know you tell me what your job is like. And you tell me that you got to leave. You tell me about your health problems. And so it's like, wait, I want to solve our IRS workers. I want to end the IRS. That's where I'm at. So that's kind of where I'm at that one. So hopefully you got your $2 value there. Thank you for your comment. So, so that's what I got there on that. But I think, John, and what I would say, the action people should take, and let me just get up to your blog here, because I do want to give a shout out to the guys who got this through, because really they're heroes, right? Stuart E. Horowitz at Horowitz Law, London, and Max Reed at Polaris Tax Council. They're really the ones who did this, and we want to definitely, way to go, guys, and also your clients. John and I have said this multiple times. You guys are heroes, because I heard the argument. You can't do that. The code's there. You can't do that. You can't do that. You can't win. You can't win. You can't fight. Well, there it is. You guys won, right? You guys won anyway, despite of what the industry will tell you. You guys won. So just wonderful, great news for your clients, and really giving us some positive movement here, at least. And what's great about it is demonstrated the issue very clearly. How the U.S. how the U.S. tax code was written to avoid the treaty, being applied. That's what we really have here. So we actually got the justice. So there's a lot of people out there, I guess, John, that could amend their returns. Now, was there any language about? Is there a limitation on how many years you can go back to amend?
I have a feeling it's 10 years, but I'm not an expert on that.
All right, I'm going to have to look at that, because this is going to affect a lot of our clients, and this is really why I wanted to get to this today. Because if you have been paying the net investment income tax, we have a few ourselves, so we're going to reach out to them to say, hey guys, if you want to amend your returns and get that money, hey, give us a ring there, and actually do that. So we're going to reach out to our current clients, but I do want to give and I do want to just give a plug for myself and for John as well. I'll start with a plug for John. If you're thinking about renouncing your citizenship, okay, folks, I really suggest you go to John. Really few people understands these issues as well as he does. And he really gets into it. And hopefully we'll get some more comments going here. So if you want to reach out to him, send him a confidential email, citizenshipsolutions@proton.mail. And I mean, look, there's only one reason why this channel has the content it does to a large degree, and it's John Richardson. And he has enlightened me. He's enlightened my team. He's enlightened our clients. He enlightens our audience. He really understands these issues at a fundamental level and just won't look at some. This is what I would say. There's your anti-artificial intelligence dude. There's just your intelligence dude. John takes no shortcuts. He wants to look at everything. So he's so thorough. And I think that's what makes our content so good, is that we really get down to the issues and explain where it is. And so I would just, again, suggest if you're thinking about renouncing your citizenship, to reach out there. Now, I do want to give myself a plug, because if you're thinking about a way to support this channel, which would be very appreciated, hey, guess what? I have an incredible tax team, and we do. Look, as you know, I'm an advocate for complete repeal of so many things, and as you know, we fight tooth and nail, and as you know, we are on the client side. So we also do tax preparation. So a lot of people. Oh wait, hold on, that's the wrong link. Let me get you to the link that for prep. It's a little easier there. We do tax preparation. So if you are looking to get your tax returns done, a lot of people are now sign up now. And also be happy to talk to you about your issues and a few things that we do a little bit differently. We don't take the industry standard that all mutual funds are PFIX. All ETFs are PFIX. That's not necessarily true if you look at it. And John and I have gone over this issue extensively. So if you're looking for an alternative way to treat your PFIX other than your 8621 awful whatever market-to-market election, there are things that are certainly PFIX, and we know when we could recognize them, but there's things that certainly aren't, and the risk of not doing it is non-existent. And the IRS, by the way, doesn't have a practice, does not have an audit guide for PFIX. Does not. Interesting. So if you were looking for tax prep for 2024, give a link there. Or if you're thinking about amending your returns to claim some money that you're entitled to, also you can book a time there to speak to us there. So I wanted to get that out there. People do ask how they can support the channel. That is a fantastic way. And really, we pick up our best clients from this channel, because you're pretty smart if you watch this. So just saying. So that's what I just want to give for a plug. Also, Keith's not here. He's not feeling well, but I do want to give a plug to his channel. on Facebook. We have a lot of people who probably watch it from here. A lot of people in France, a lot of people who this affects. So hopefully, and I'm sure Keith will be pushing this out there too to make sure he's educating people. He's got 11,000 people in that group. So this is really, really important stuff to get out there and share. And that's what we always ask people to do. Make sure you share this comment as you can. So let's see if we got any good comments here. Well, we just might got comments, so we just might be spam. So let's see if we got anything good here. All right, here. You know what? I'll just go with it here. I think a lot of people are fearing the IRS is going to go away. Look, this comment: what will happen to collections or banks levies? Guys, I like that people think the IRS is going to go away. They're really optimistic. I don't know here.
It's not going anywhere. Believe me,
guys,
it's not going anywhere.
There's a whole industry. There is billions and billions of dollars that goes into making sure the U.S. tax code exists to some form. You're asking a lot of people to give up their entire worth, and they have no other way to make money than doing taxes, and everything's in it. So, I want to be as hopeful as the next person, but I don't see how that's going to end. And Trump ending the personal tax. I wish that was true, Al. And I know he's put some stuff out there. He's put some stuff out there to say that he would. And I know we've had the fair tax guys on as well. I don't know. That would be something, Al. We would love to see it. And IRS, no, Nevada. Wait a second, Nevada. No. You got it exactly wrong. Nevada 2020, IRS workers will stay busy in examining millions of business tax returns. Exactly backwards. Exactly backwards. No. The U.S. tax code is too complicated for the IRS to administer. So what they do is they focuses on the easiest cases. What are the easiest cases to audit? Earned income tax credit. There, you're auditing poor people by mail who don't even know they're being audited. You're gonna win. Number 2, Schedule C. The small returns, people making under $200,000 who file a Schedule C, those who are audited. If you are wealthy or if you file a return, if you file a partnership return, your audit rate is about 1 in 2,000. 1 in 2,000. I talked to a friend of mine who actually did have a partnership audit. He goes, yeah, I can't believe it. But it actually was for earned, it was employee retention credit. So I'm like, well, that doesn't even really count. So no, you actually got it backwards in Nevada 2020. The IRS works on the simplest cases because they don't have the team that can do. Oh yes, Al Sanderson, this is what we're talking about. Should we donate our refunds to this channel? There we go. I love that. Now that's a comment. That is a comment I can 100% stand by. So please, however people are donating, please donate. You could do that. I'm not sure there's a mechanism to directly donate, but it sounds like there is because someone just gave me $1. I mean, look at that, $1.99. Look at that, $1.99. Oh, I got to pay taxes on that. Oh, dang. All right. Well, so much for that. So, John, I think, John, I got to just thank you so much for this today, John. What would you like to add? Did I cut you off on anything? I probably did.
I don't know. We can go on forever on this thing. I think what I would say is this, that I would assume, I don't have any inside knowledge on this, right? But I would assume that the IRS will be appealing this in the same way they appealed the Christensen case, etc. I think that this is, I think it's the right decision. I think this is a courageous decision from Judge Solomson. And I think that at the end of the day, I think it's the right decision. I mean, I just cannot imagine how in the long run the consensus can be on this, that a provision of a U.S. tax treaty that requires the U.S. to give a credit as long as it's, if they want to, can possibly be construed to be a reasonable interpretation. Okay, a few add-ons here. If you go, maybe you want to put the link to that blog post.
Oh, absolutely. Yeah, let me get that over here. Yeah,
so if you want
it's a long, it's a long URL. I don't know if it might get broken here in the comments, but let me see.
Whatever. I mean, if you want to understand more on this, I would look at that. Other points I would add, though, where I think the decision is particularly rich. I mean, I know that, people are concerned with the result, which is very positive, but where this is extremely rich is, as Anthony pointed out, when he gets into the rules for treaty interpretation. And where Judge Blank, Judge Solomson, and others have said over the years on treaty interpretation is that you look to the intention of the treaty partners. And my God, I mean, it is absolutely inconceivable to me. And the government of Canada did support Mr. Bruyea apparently on this. It's inconceivable to me that the government of Canada, which would be the treaty partner country, would ever have expected, the U.S. to create this tax on its own residents and then not provide a foreign tax credit. So, that's extremely significant. He also makes, on a third level, some very interesting comments on the issue of tax treaty overrides, because all countries override tax treaties, by the way, not just the United States. But this is a little bit more of a complication with the United States because of this sort of last in time rule where Congress and, treaties have equal stature, so to speak. So you look to the last thing enacted. And what he seems to be saying is, and this is very important, is that to have a treaty override, you need an actual intention in the legislation or the process to actually override a treaty. And, I think, honestly, I think that type of stuff probably is of more value long run, than the relief provided to Americans abroad. But make no mistake about it, this is an extremely significant case. I noticed in your description you said that this would be worth money to Americans abroad. I would agree that at least for people in Canada, and I think everybody, but certainly for people in Canada, I think you ought to talk to your tax preparer about the possibility of amending returns if you paid this. And my advice would be to amend the returns, because I think that somewhere along the way, I think that these people need to understand that there's an administrative cost to taking unreasonable positions as well on this. So,
John,
that's kind of all I have to say on this. I mean, this has been a very technical topic we've talked about today, but I have one topic that somebody called me yesterday that I'd like to introduce to you as a possible podcast, if you're interested in
Ooh, yeah, we're teasing next time here. All right, let's hear it here.
Well, maybe not next time, but I'd never thought of this before. But I got an email yesterday. It wasn't an email, it was a phone call. I got a phone call from somebody yesterday who said that they had a relative incarcerated in the United, that means in prison in the United States, and wanted to discuss filing a U.S. tax return. So, I thought about this sort of momentarily. I don't quite understand why I would think that somebody locked up would have bigger problems than filing tax returns. But that's that. It was interesting that, that you see, even when incarcerated, people understand the most important thing is filing a tax return. But, does that meet the substantial presence test, Anthony? If you've been incarcerated for 3 years, you've obviously spent more than 120 days in the United States. Have you tripped the substantial presence test?
Oh my God! So somebody, right? I guess here's to put it into example. We have the Roger Ver case, right? Roger Ver is no longer a U.S. person. The U.S. is seeking to extradite him for claiming wrong figures on his exit.
Yeah. So they scoop him up, bring him to the United States, throw him in a prison, keep him there for over 120 days for 3 years, or more than 183 days in 1 year. I mean, has he become a U.S. tax resident under the substantial presence test?
Oh my goodness! Now they could tax his worldwide income.
That's exactly right, and require all these penalty-laden information returns.
Oh my! You thought you left, but you didn't. Oh my God! That would be something.
Isn't that?
Yeah, I think we might. That would be an interesting topic to discuss. Is that forced U.S. tax residency?
I mean, why not just go around the world and kidnap? Rich residents of other countries, lock them up long enough to meet the substantial presence test, and then fine them and tax them.
Right, and penalize them. And don't forget those penalties, John. Those penalties are, really. Those are the things that.
Well, exactly.
Those are the things that soothe those Treasury employees. Like, oh, we have bad news here, but hey, look, there was someone who retired who needed this money to live on, but we're able to destroy them and their family. Oh, thank goodness. Thank goodness we still have something that we believe in.
I mean, this is a new business for somebody. Why don't we call it the Jailhouse Tax Lawyer? What do you think?
Yeah.
Jailhouse Tax Prep. And can you imagine lawyers arguing? Can you imagine a lawyer arguing on sentencing? Please, let's keep this below this certain amount so they don't become a U.S. tax resident.
Yeah. Well, I would say, we do. All right. Well, I think we have some interest. Al wants to know, could the money the prison is getting for incarceration be considered income? Of course it is, Al. It's something. It exists. Of course, Al. Of course it would be income. Look, we don't even need to have income to have income. The idea of income, so the idea of someone else having income at some point is enough for income, according to the transition tax. And likewise, yeah, we were right. We did have a tariff-based economy. We had a limited government back then, and we had sound money as well. We had sound money and a limited government. So two things we don't have anymore at all. And is Prince? Prince Harry is liable for his UK assets. I would say I'm going to imagine Prince Harry's going to have PFICs. My guess is he would.
Well, the issue with somebody like Prince Harry, though, remember he's not incarcerated. Okay, in the sense of being physically locked.
Yeah.
Okay. But we won't go with where you were going. Okay. So he's not physically locked up in a U.S. penitentiary. But either way, I think there may be a possibility of somebody like Prince Harry using a treaty tiebreak provision, right?
Yes.
And maybe that's the answer. Maybe that's in fact the answer to this issue of it's funny. I think that might be the answer. That you would take the position that while incarcerated, maybe somebody's a treaty non-resident.
Oh, right. Closer. Yeah, there you go. Yeah, but you're over your 183 days, so you're not going to be able to do the closer connection. So it's like, you're right.
That's right. But the closer connection thing, I remember that's different from treaty non-residence. I would explore, can you take the position you're a treaty non-resident because of a closer connection to the other?
But then you need a treaty. Then you need to be,
well, that's right. But I mean, there's plenty of criminals from countries,
right,
or not criminals. There are plenty of people who are incarcerated, whether criminal or not, who are citizens and residents of treaty partner countries, right?
Yeah.
So maybe that's the right way to go on this.
All right. Well, I think I have the comment to conclude today with that. I really like it here, and I think this is the way to go because when we're talking about treaties, we're talking about treaties in the United States of America. Well, Johnny Thunders, just remember this: treaties mean what the United States say they mean, right? And the treaty with the Great White Father in Washington. That's the Cherokee and Lakota Sioux. How that worked out.
It's it's not just the United States. The United States, Canada, these are essentially just modern day extensions of the British Empire, right?
Yeah.
And a lot of this just comes back, to the thoughts on what treaties were, and the tragedy of the treaties is really twofold. First, that the treaties were, I think are ways of essentially planting flags, right, in another place on, Native American, indigenous, Indian, whatever you want to call it, land. But the real problem with this, as I can't remember the title of this book, is that, these people never had any concept of property rights, or ownership, stuff like that. So, terribly unequal treaties in so many ways, terribly unequal. I mean, this is just, this stuff is unbelievable, and it's so hidden, from history, etc. But anyway, yeah.
There we go. All right. Well, I want to thank everyone. Thank everyone for the comments today. Exciting day, and we are gonna be, exactly. Some things are going to be happening today. President Trump is going to be in presidency pretty soon. So we'll see how all that works out. Again, I just want to thank my great guest, the great John Richardson. Thank you so much, John. And again, I'm Anthony Parent of IRSMedic. Thanks for watching.